Today, Wall Street is asking one question. Tesla just lost $47 per share. The stock is down over 12%. And if you looked at the market reaction, you would think something has gone terribly wrong. The headlines are screaming. Analysts are focused on shrinking automotive margins. The stock is being sold aggressively. And once again, the conversation is centered across the same questions we have heard for years on vehicle deliveries, quarterly margins, short term earnings. But here's a question I want you to think about. Did Tesla really become 12% less valuable overnight? Did Tesla lose 12% of its technological advantage? Did Tesla lose 12% of its AI capability? Did it lose 12% of its robotic opportunity or its energy business? Or is the Wall Street looking at the wrong scorecard? Is it an overreaction or repricing? Because if you listen carefully to what happened on the Q2 earnings call, you start to realize something remarkable. Many traditional analysts are still valuing Tesla using an old framework designed for the 1990s car company. They just see Tesla as an automaker. Tesla sees something entirely different. A vertically integrated platform combining vehicles, AI, autonomy, robotics, energy generation, energy storage, and software. In other words, Wall Street is still valuing Tesla as a company it was, not the company it's about to become. Now, before we go any further, a quick disclaimer. I'm extremely bullish on Tesla, but I'm not a financial advisor. Everything in this video is my personal analysis and opinion. Please do your own research before you make any investment decisions. Now, because I listened to this call really carefully, I didn't hear the company slowing down. I heard the company investing aggressively. I heard a company building AI infrastructure. I heard a company expanding autonomy. I heard a company developing robotics. And I heard a company that's trying to create one of the most profitable ecosystems ever assembled. Today, we are going to talk about the earnings call, play Elon's exact comments, examine what the market is reacting to, and more importantly, examine what the market may be missing. And that brings us to the single most misunderstood part of Tesla's business today, the vehicle demand. Mainstream media loves to claim EV interest is plateauing, but they miss the core shift. FSD isn't an option anymore. It is becoming the primary reasons people buy Tesla in the first place. If you look at the report, over 55% of all new Tesla deliveries in North America now come with an FSD subscription. That is recurring, high margin software stream tied directly to physical hardware. It's got the margins are like that of a software business. Here is Elon describing what customers actually saying when they walk into Tesla stores. Listen in.
And we're seeing in locations that have FSD approved, we're seeing a very high take rate of FSD. And in fact, I think for a lot of people, they're actually buying Tesla full self-driving with a car attached, as opposed to a car with FSD. They're coming into our stores in the US and saying they want the full self-driving and with whatever car it comes with, essentially.
Think about how big of a paradigm shift this is. Legacy automakers build a car and hope you come back in 5 years for a trade-in. Tesla sells software wrapped in steel. When FSD transitions from supervised to unsupervised, that 55% take rate will shoot closer to 100%. People aren't just buying cars anymore. They are buying an autonomous asset that generates value. That software margin alone completely changes Tesla's valuation model. Next up is the segment that Wall Street completely ignores, Tesla Energy. While everyone focuses on quarterly car deliveries, Tesla's energy storage division is exploding. AI data centers around the world are running into a massive wall. The total lack of available power grid infrastructure, Tesla Energy is uniquely positioned to solve that exact bottleneck. Listen into how Elon connects energy storage directly to the future of AI infrastructure.
The energy business is also growing incredibly fast, and I think will be crucial for the scale up of artificial intelligence data centers. We're investing a lot in growing the core business and really preparing for the future. So
This is a hidden multi-billion dollar catalyst. Tech giants like Microsoft, Amazon, and Google are spending hundreds of billions on the AI clusters, but they can't get power fast enough from traditional utility companies. And look at Tesla Megapods. They have the ability to provide instant scalable grid stabilization. On top of that, Tesla has already roughly 7 gigawatts of power capacity in their global supercharging stations. They can drop megapods right at extending sites to run distributed AI workloads off their grid. Tesla Energy isn't just a side business anymore. It is the power backbone of AI revolution. Next, in the earning call, they covered CapEx spending, cautious robotaxi scaling. And I think this is what is impacting the stock today. Now, why did Tesla's cash flow dip slightly this quarter? Because they are pouring capital into high returning investments. Tesla spent almost 6 billion in CapEx in a single quarter. Short-term traders see heavy spending as negative. Long-term investors realize this is how you build a moat. Listen into this.
This is a massive CapEx year, but I'm confident that all the things that we're investing in will yield incredible returns. Really, maybe the best CapEx returns that we've ever seen.
This is a hidden multi-billion dollar catalyst. Tech giants like Microsoft, Amazon, and Google are spending hundreds of billions of dollars on AI clusters. But they can't get power fast enough from traditional utility companies. However, Tesla Megapacks, Megapods provide instant scalable grid stabilization. On top of that, Tesla already has roughly 7 gigawatts of power capacity at their global supercharger stations. They can drop megapods right at existing sites to run distributed AI workloads off their own grid. Tesla Energy isn't just a side business anymore. It is the power backbone for the AI revolution. Next, in the earnings call, they talked about CapEx spending and how cautiously they are scaling robotaxi operations. So, why did Tesla's cash flow dip slightly this quarter? This is because they are pouring capital into high return investments. Tesla spent almost 6 billion in capex in a single quarter. Short-term traders see this as heavy spending as negative, whereas long-term investors realize this is how you build a moat. Listen into the next segment of the earnings call.
This is a massive CapEx year, but I'm confident that all the things that we're investing in will yield incredible returns. Really, maybe the best CapEx returns that we've ever seen.
So where is this huge chunk of capex going? Robotaxi scaling. Critics always complain that robotaxi deployment is taking far too long. But as Elon makes it clear, Tesla isn't constrained by technology. They are deliberately moving carefully to protect human lives and also to prevent regulatory overreaction.
With Robotaxi, our goals are very ambitious for Robotaxi, but we do need to be cautious about causing any accidents or causing any harm to anyone. Although there are, I think, 30 to 40,000 automotive deaths per year in the United States alone, most of those do not generate any press on it. You never really read about almost any of those. But if we injure even one person, it will be worldwide headline news. And regulators will immediately clamp down on our activities. And we don't want to injure anyone. So we're going as fast as humanly possible in scaling Robotaxi, but while trying to ensure that we do not harm anyone at all.
This is the smartest approach Tesla could take. Tens of thousands of people die in human-driven car crashes every year and nobody blinks. But one single headline involving an autonomous vehicle, it can actually delay regulatory approval for months. Tesla has racked over 380,000 unsupervised miles with zero major safety incident. Tesla is building an airtight regulatory case that legacy competitors which rely on expensive LiDAR technology, they simply cannot match this. Finally, let's talk about Optimus and Terrafab. These are the two products that will make Tesla the most valuable company on earth. Elon laid out the realistic engineering timeline for humanoid robots. He also warned investors that manufacturing Optimus isn't like building a car. There is zero existing supply chain for it. Listen in.
This is going to be the hardest product to scale manufacturing that we've ever made at Tesla because everything on the robot is new. And the difficulty of scaling the production ramp is proportionate to the newness of the parts in the robot. And at least with electric cars, the non-electric powertrain portions of the cars had an existing supply chain. So you could go to existing suppliers for wheels and side mirrors and windshield glass and that kind of thing, body panels. But with Optimus, there is no supply chain. So we've had to build up a supply chain in its entirety or in-house the production. And we actually have in-housed a tremendous amount. Optimus production line that we're building out in Fremont in place of what used to be the Model SX production. It looks incredible. It's quite stunning to see. So I just want to make sure to calibrate people correctly. Optimus will follow the sort of normal S curve of a manufacturing ramp, but the initial portion of the X curve will be quite flat and long because of the newness of the parts in the robot.
Notice how transparent Elon is about the S curve? The beginning will look slow because they are manufacturing every single custom actuator, hand joint, and sensor in house. But once the supply chain matures, scaling is going to be exponential. And to run millions of Optimus units, Tesla can't rely on third party chip suppliers. And that is why they are building Terrafab. This is what he had to say about Terrafab. Listen in.
But I do think Terrafab is going to be an amazing initiative and a necessary one without which we will be constrained in our ability to scale Optimus production because we simply won't have enough AI chips. So it's crucial to solve that, and we'll have to solve memory, logic, and packaging in order to scale Optimus. But anyway, like I said, we'll leave that to its own announcement.
So, controlling the chip design, the packaging, the software, the battery storage, and the robotic hardware under one roof is something no other company in the world is doing. NVIDIA built the chips, Boston Dynamics built hardware, OpenAI builds model. Tesla is building all the three simultaneously. That vertical integration creates an unbeatable cost advantage. So, when you zoom out of the quarterly noise, the narrative becomes crystal clear. Software adoption is surging with 55% North American FSD take rates. Energy storage is stepping up to solve the global AI power shortage. Robotaxi fleet is scaling and it's setting incredible safety milestones. Optimus and Terrafab are laying the groundwork for a multi-trillion-dollar robotic business. This post-earnings pullback is a classic Wall Street short-sightedness. For long-term investors who understand where the world is going, Tesla is a no-brainer buy. What are your thoughts on the Q2 earnings? Drop a comment below, hit that like button, and subscribe for more deep dives for future.